Welcome to the Budget 2023 edition of Tax Snax. I'm Harriet Brown and I am here with Ross Birkbeck, Rebecca Sheldon, Jon-Selous Borlace and Shane O'Driscoll. We are all barristers at Old Square Tax Chambers and we are going to give you a quick, well hopefully relatively quick summary of the budget. And I should say, if all of our lighting looks a little bit weird, this is Tax Snax After Dark because we are actually doing this on the evening of the budget. So welcome. This was not the most interesting budget for tax. I think it's fair to say. Tax was not at the forefront, but there's certainly enough for us to talk about. So we've got a few headlines. From a business tax perspective, probably the main headline really is the full expensing, which I think Ross is going to take us through in a little bit. It has been confirmed that the corporation tax rate is going up to 25% for those companies with the biggest profits, though if you look in the details of the budget, it does still maintains that only 10% of companies will actually pay that 25% rate. And we've had quite a lot of research and development incentives. In relation to personal tax, the big news there is that the pension lifetime allowance has been scrapped, and while I think we were all expecting that to increase, I don't think we were expecting it to go altogether. In indirect taxes, we've maybe had the freezing of fuel and alcohol duties, and we're going to talk about some of the more interesting indirect tax measures, and then we're also going to just dot here and there in what we're talking about some of the things that were mentioned at last year's autumn statement, but which you might have forgotten about, and we'll keep reminding you about those too. So I think first of all, we are going to look at business taxes. And so business taxes, it hasn't looked so great since the autumn statement, because we've obviously got this sliding rate of corporation tax going up to 25%. But that's just the headline, and it's not all bad news because we have got some significant sort of breaks, exemptions, reliefs. And probably the most significant of these is full expensing, Ross.
Yeah, exactly. Which is, I mean, the full expensing is almost a sort of conceptual shift with the idea that capital allowance scheme has now been expanded almost to cover basically everything. So, all capital expenditure is going to be offset against income for corporation tax purposes. I mean, technically, the measures split into three sections. We've got full expensing for the main rate, the plant and machinery. There's a 50% first year allowance now for companies against the new special rate, and then we've got an annual investment allowance as well, of 100% first year relief. So it's still three separate measures, but the big move is the full expensing for all plant and machinery and on the main rate, and that's going to cover most capital expenditure really. It would simplify things a lot as well.
I was going to say, do you think this is going to sort of simplify capital allowances, which is a notoriously sort of tricky area, isn't it?
Yeah, I mean, unfortunately, I don't have to do too many capital allowance calculations, but I think they'll be easier now because it really, 100%, great.
And I guess the other question, is it better than a 19% corporation tax rate?
Well, I think the whole point is that if you want to throw money at your business, it is because you can grow your business and pay, well, potentially obviously no tax if you invest enough, and that's going to be better for that's the idea is to encourage companies to put their money back into the business and pay less tax. Obviously, if a company's making a lot of profit and not doing much investing, it's going to make less difference.
Yes, and you've talked about the idea that the budget's intended to facilitate growth. And I think one of the key areas for growth has definitely been research and development. So as previously announced, we've got the research and development expenditure credit rate, which is going to increase to 20% from 13%, and that's from the 1st of April 2023. So we knew that was one of the autumn statement measures. But what we have got now as well is an increase in the rate of relief for research and development intensive small and medium enterprises. And this is quite significant. It's effectively a relief that's going to be worth £27 for every £100 of research and development investment. We don't have much detail on this yet. I know that in his speech, the Chancellor said that it was going to apply where you put more than 40% of your total expenditure in research and development, but I haven't found that in the budget. itself in the actual document. So
because it's up from about £14 per 100, isn't
yeah,
it? Tax credit was small.
Yeah, it's a very decent increase, but as I say, we don't have many details. So in terms of, I mean, one of the things that I always think about when we have these changes is not only what is the overall tax position, but additionally, is it going to make things more difficult or easier from the perspective of people trying to run a business? Because the last thing that you really want is an incredibly complex system where you're spending a lot of money just to work out what you're entitled to. So it will be interesting to see the details of that.
Yeah, it'd be interesting. It's also whether it runs contrary to the revenue are cracking down on the R&D claims quite hard at the moment, it seems. And they're also talking about simplifying the whole system and moving just to an RDEC system and getting rid of the bits more. So it's really interesting to see how this plays into those changes.
There does seem to be a bit of tension there, doesn't there? And I'm going to come onto this in a bit more detail when I talk about the audio-visual tax credit reforms, because you seem to have, on the one hand, the government being very keen on innovative technology and creative industries and sort of trying to incentivize them, but then on the other hand you have the policy approach almost of HMRC, which seems to be at odds with that. And of course, I think you and Rebecca with Rory Mullen Casey have got a talk on research and development coming up.
We've got in a couple of weeks. We're looking at the R&D changes, so I'm sure this will factor into that somehow.
It'll get a mention.
I think it's me looking at the new law, so
oh, lucky you.
Tune in a couple of weeks for the detailed analysis.
So turning then, I'd mentioned that there's going to be an overhaul of the audiovisual tax credit, and this is going to ultimately give a higher rate of relief. So what's happened there is we've had a public consultation, and film, TV and games tax reliefs are going to be reformed, and what you're going to have is expenditure credits instead of additional deductions. We've still got a year to play with this. That doesn't come in until the 1st of April 2024, and you're going to have one audio-visual expenditure credit, and that's going to replace film, high-end TV, animation and children's TV tax reliefs. Film and high-end TV, the credit rate is going to be 34%. For everything else, it's going to be 39%, and that includes animation. I think Rebecca and I have done a handful of cases recently on animation companies trying to get enterprise investment scheme relief, or seed enterprise investment scheme relief in one case. And I think we can say that the idea that animation companies should be getting credit is not one that HMRC are particularly keen on from our experience in those cases. So high-end TV expenditure threshold is going to remain at £1 million an hour. Video games expenditure credit is going to have a rate of 34%, and qualifying expenditure for that video game credit it has to be expenditure on goods and services within the UK. Now, this is an area where we do have quite a bit more detail because we had the consultation document. I'm not going to go into that in too much detail because we've got a lot to get through, but looking at an example, what the sort of consultation says about, or the response to the consultation says about animation relief, is that you can get animation tax relief if the programme is certified as British by the BFI, it's intended for broadcast, including streaming online, at least 51% of the core costs are spent on animation, and at least 10% of the core costs relate to activities in the UK. Core costs, I think, are going to be pre-production, principal photography and post-production costs. I'm not that sure what other costs there are, but anyway, there we go. And it then goes on to say that there's going to be a requirement that the company is responsible for the pre-production, the principal photography, the post-production and the delivery of the completed programme, and that it must also be actively engaged in planning and decision-making, directly negotiate, contract and pay for rights, goods and services. So again, as I say, Rebecca and I have done a handful of cases. We've got something called Coconut Animated Islands, which has been to the first tier, CHF PIP, and there's another one kicking about at the moment which wasn't ours but called Hoopla. And in all of those cases, what was very interesting was HMRC were arguing that you couldn't subcontract these things out. It had to sort of be done in-house. And looking at that, certainly that first sort of list of requirements that you've got to be responsible for pre-production, principal photography, etc., it does make me wonder if that is going to sort of be a restriction on things like subcontracting out. I know it's a different type of process to EIS, but I do just wonder if that's sort of in their minds a little bit. So it'll be interesting to see how that develops.
Yeah, it looks like it's sort of targeted more at the production companies rather than the financiers and the marketing sides of it, obviously.
Yes, and I think that is sort of it wouldn't be fair to call it a scheme, but I think the problem with EIS and the animation companies is that they've sort of tried to hive it down to a lower level and then subcontract back up, and whether or not that's allowable, HMRC certainly don't like it. And I think, as you say, this is going to focus it much more at that sort of nuts and bolts level rather than being available to people higher up the chain. So I think that now, Ross, takes us back to you.
Yeah, I mean, so that takes me, I was going to briefly mention the community investment tax relief and the REITs, the real estate investment trusts changes. I mean, this is a budget of many small giveaways, I think, and this is two examples. I mean, the community investment tax relief expansion, as it's been called, it is to expand the limits that apply to the funds that can be raised and deployed by accredited community development finance institutions. So that's really just allowing, trying to open the gate to allow a bit more money into the CITR relief. Probably of niche interest. The REIT change perhaps is a bit more widespread. So what this changes, for example, to the qualification requirements for companies to be accredited as a real estate investment trust. So, for example, companies that have only 3 properties and one over 20 million, going to relax those restrictions and allow REIT accreditation a bit more broadly. So that could be interesting for companies with property portfolios who are interested in getting REIT treatment, but who don't quite qualify. Might be worth looking at again following these changes.
Yeah, so I mean that's, as you say, I think that's a really good description of a budget of small giveaways. And on that basis, I think you're right. It is just worth in the business tax arena looking and seeing where things have been slightly adjusted, because you might just fall within a relief or an exemption or a credit that you weren't entitled to before.
Yeah.
So on to something a bit broader, and I think Shane, you're going to take us through the cash basis consultation.
Yes, so consultation was announced, which is open until the 7th of June of this year, where they're canvassing opinions and options on whether or not to extend the self-employed cash basis. In effect, the cash basis, I'm sure you're all aware, would be a simplified way of calculating taxable profits for income tax purposes, taking basically the difference between income and expenditure when money is actually received and paid out. So this is a regime that's been around for some time. However, the uptake of the regime hasn't been very good, and they're trying to figure out, why that is, and also what tweaks they can make to that regime to perhaps simplify how people get to use this going forward. So the point really.
They expanded it a few years ago, didn't they, from businesses with a turnover of under 150 to those with turnover of 300 or 300,000 or under. Sorry.
Yeah. Yeah.
Is there any sense
of
why they care? I mean, sorry. I'm just.
From what they do sort of focus on tax simplification, Shane, is that right?
Yeah. Yes.
Yeah, that's the idea, to sort of make it more accessible, I suppose. Yeah.
Correct. Yeah, and there's also some of the other bits or some of the other options that are open to you if you're going by the cash basis as opposed to an accrual type basis. There are certain portions of the tax system at the moment that wouldn't apply or that you can't benefit from. So, for example, this is one of the 4 points really that they're focusing on. One, they're looking at the the entry point and exit point, or the thresholds basically of when this regime could apply. So they're talking about tweaking that figure. He said sort of potentially removing the cap altogether or aligning it with the VAT cash accounting scheme turnover of below 1.35 million. They're talking about setting the default as being the cash basis as opposed to the accruals basis. So at the moment, you have to tick a box in your annual return to get the benefit of the cash basis. And they say at the moment, basically, there's about a third of the customers who would be eligible, or businesses that would be eligible to use the cash basis. There's only about a third of those who are actually signed up and using it.
So it's simplification, really. I mean, a lot of these measures look like a push for simplification, don't they? A lot of the consultations and stuff like that.
But I mean, presumably the cash basis could facilitate cash flow, particularly if you maybe have large debtors or you know. So presumably it would be useful to the 2/3 of the eligible people not using it if they at least knew it was an option.
And this is one of the points that's made in the consultation paper. So they believe that certain people opt into it and then opt out and then opt back in. And it's unclear why that is happening. And they're not sure whether that's just purely errors in the return, people not ticking the box, for example, or whether their actual business changes. So as you say, maybe they have a lot of creditors or otherwise that might make that type of thing relevant. The other things that they're looking at is there's a current limit of £500 on interest deductions if you're going via the cash basis. They're trying to figure out whether 500 is an appropriate level or where they should move that to. And then they're also looking at relaxing restrictions on using relief for losses made on the cash basis.
Yeah, because at the moment you can only use a loss on the cash base against trade profits. Is that right? Correct.
And you can't benefit from sideways relief or such
right.
other.
Yeah, you can't use it. Yeah, can't use it against your general income. So yeah. This seems like a pretty good thing for sort of those smaller unincorporated businesses then.
It should simplify their tax obligations and their accountancy obligations that happen in the background in preparing figures, etc. Now, whether that works out in practice or not is another question. However, that's
if they know it's available. I suppose if it's put as the standard basis and you have to tick to opt into the accruals, then maybe
correct.
That will do it. Okay. Excellent. But we've not got that yet. That's not coming in until 25-26, is that right?
I presume so. So if the consultation finishes up in 23, probably a year later before they report on it, and then maybe a year after that before it actually applies.
Fantastic. So just to round off on business taxes, Rebecca, could you talk to us about enterprise management incentives?
Yep, sure. So for those of you who don't know, the EMI scheme is a tax-advantaged employee share scheme. It's aimed at small to medium businesses, and the point of it was so that people would be able to compete with the larger firms and both get and then retain high-skilled employees. There's been a consultation, as the government said they would do, and we've got the responses to that. Basically, everybody agrees that it's doing what it was intended to do. The only slight surprise, I think, on reading it is that I think 2/3 of respondents said they didn't think there was a causal relationship between having the shares and retaining key staff. So you would think how everyone's happy with it, I'm not sure, but that seems to be the overall take from the rest of the consultation summary. I don't know if anyone else has any views on that.
Well, no, the only view I have is, and it's not really about that. So you see, consultations are a huge feature of modern sort of tax the modern tax legislating procedure. And I just want to ask, have any of you ever responded to a consultation?
No.
I know it's not addressed at me.
However, we are available to help you draft a response.
I have responded to one once, but it wasn't in the UK. It was in Jersey, and it wasn't about tax. It was about trusts. Yeah. So I don't know. I mean, and I know the sort of the professional bodies do a great job of responding, but
well, you say a great job. I mean, you would have thought loads of people would respond to that one because it's quite an important relief. 48 people
Oh,
or
wow.
entities responded.
Wow. Only.
So, yeah,
Maybe we all need to be a bit more proactive then. Let's
we
look at the consultations we can respond to. Shane, you'll be all over the cash basis consultation.
Happy to do it.
And so I think that takes us to pension taxes, and something that wasn't really consulted on at all. Rebecca, pension allowances. That's been sort of what the big headline, I think, for personal taxes.
Well, I mean, this is the exciting one, isn't it? And also deeply depressing one, because I only just learned how to calculate it. So they have got rid of the lifetime allowance. The reason that they cite for that is because doctors, so they say, have been either retiring early because they don't want to go over the lifetime allowance, and they think that's part of the crisis. Query whether that's actually correct, but there we go. So the idea is that you'll get more doctors staying on later, and also doctors coming out of retirement. So that's the theory. We'll see if it works. We've also got some other changes. So the annual allowance is increasing from 40,000 to 60,000. Which is
not until next year, I think. Is that right?
Yeah, that's not till next year.
24, yeah.
Yeah. And I mean, I think those are the main ones. There's a small change to the money purchase annual allowance going from 4,000 to 10,000. And beyond that, I think that's pretty much it.
I mean, it's a nice simple headline, and it's an interesting sort of turnaround, because in my professional lifetime, if I can put it that way, the lifetime allowance has shot right down and has now just disappeared altogether. So I mean, I think they nearly halved it. It used to be over 2 million or 2 million, I think, and that came down to where it was until today.
But this was also a surprise, wasn't it? Because wasn't the expectation that they were just going to hire it again?
Yeah, I think we thought everyone was thinking they were going to raise it, and then it's gone altogether. And how much of an incentive to stay in work for doctors or anybody it's going to be, I don't know. I mean, I suppose, it's going to depend on the individual, but probably a very welcome change from a personal tax perspective. And so really there isn't a great deal else going on. We've got lots of sort of little bits and pieces to talk about in personal tax, and I think Selou, you were going to talk to us about some sort of administrative changes that are going on.
So this feeds into the government's Making Tax digital program, which they've already rolled out in relation to VAT. They're now going to extend it to self-assessment. So starting from 2026, self-employed individuals and landlords are going to have to submit their returns in accordance with the Making Tax digital program. So essentially, digital returns, quarterly updates, and so forth. It's not going to be all self-employed individuals or all self-employed landlords, but it will be most of them, because it's anyone with an annual income over £50,000.
Okay, and so is that going to make a difference to the way that we pay tax, or is it just going to make a difference to the way that we return income tax?
The way we return income tax,
Right,
and the idea it makes it more efficient and presumably helps with tax gap and so forth.
Yeah, and a lot of this is very much in line with the consultation paper also announced today and put out about reforming the way income tax is collected. It's communicated, and reforming the way HMRC communicate with income tax payers. There's a lot of there's a consultation looking at basically how do HMRC get rid of paper, and this is like, obviously Making Tax digital is a big part of that and trying to simplify this, and they obviously convinced. Well, I think I read that £40 million a year on sending post out.
What?
That's a very scary number, isn't it?
That's insane.
£40 million a year on post, and it's the least efficient and lowest customer satisfaction. So it wastes their time. None of the customers are happy.
And there's all that banter case law, isn't there, where people argue, oh, well, it wasn't received on this day, and
exactly.
And in all honesty, think of the poor person who has to lick all the stamps. Yeah.
So they're looking to move to a sort of digital first communication strategy, and this thing called the single customer account. So we're all going to get given a customer account with HMRC, and we'll be able to log in, and we'll be able to put in our details there, change our addresses, see our tax liabilities, do that whole thing, and then notices can be issued to us through that account as well.
Is it going to be a bit like the self-assessment system though, where you have like a code and then you need your mother's birthplace and then you need to find a scroll in the garden and then you need to go on a little hunt and find out where things are? I mean, is it actually going to be simpler, or are we all just going to be sat there?
Well, I mean,
out?
they're talking a grand game about, an app-like interface,
oh, wow.
in one place, and it's all going to be wonderfully futuristic and simple.
Okay.
And then obviously murmuring about, because of course we're not going to exclude anyone who's digitally disabled, or whatever the term is.
I really hope it's not that.
I think it's more religious exemptions, isn't it, rather than
yeah, exactly. So but it's like the Making Tax Digital. This obviously, they've decided, the administrative overheads of paper, as well as the cost and the inefficiencies of it, and the lack of the poor customer satisfaction of paper. They just want it out of there. So within 10 years, you'll have no choice.
What I think is really interesting is the way that Making Tax Digital is sort of driving some of these things. And again, we've got a new late filing and late payment penalty regime, which has already come in for VAT, but they're now going to bring in for income tax as well. And I think part of the reason that they can do that is because they do have this more sort of globalized approach, which Making Tax Digital is facilitating. And as far as I understand it, it's sort of a points system. So it's like your driving license, points on your tax return or whatever for being late with your filing or for paying and stuff. So I think it is interesting that we do have all of this starting to come together. It's both interesting from the perspective of the efficiencies, and like you say, 14 million quid on post is just insane. But it's also interesting in terms of how, I mean, if you look at case law that you still refer to today, how what the VAT man knew was happening, the people in income tax had no idea, and just the idea now that is also linked up and everything can be checked against each other is probably a good thing on the whole. But you do wonder if it's going to be the cause of sort of innocent mistakes perhaps being misinterpreted. I don't know.
Yeah, exactly. And they're even looking at PAYE, which I generally think of as an entirely digital system anyway. Yeah. But even there, repayments are often processed manually, and people receive those. They're still receiving checks essentially. So we also talk about sort of how to get the last bits of paper out of the PAYE system for updating codes and stuff like that, and reporting codes, changes to codes, and so if you need to change your PAYE code, actually that will be done through your single customer account, your portal, rather than having to get your employer to file some document somewhere. So it's the future, I guess.
Hopefully making things simpler for the taxpayer.
Yeah, I'll be happy.
Excellent. So then I think we've got a few little bits and pieces. So for example, if you are a crypto person, self-assessment form is changing, so you have to declare crypto assets specifically. There's going to be a specific place for those on the self-assessment form, which bafflingly the budget seems to think is going to make the Treasury money. They think having to declare them separately. I don't know why, but it's I think it's sort of saying by 2028 it's going to be sort of generating cash. So there's that, and then we have.
I wonder, is that so that because they will have visibility from the exchanges, etc., about what amount of crypto you've actually sold, etc. So
we do have CARF coming in. Yeah, we've got CARF coming, haven't we?
Yeah. So it might have something to do with that potentially.
Yeah, that's a very good point. Yeah, CARF is the crypto asset reporting framework, which is going to require crypto exchanges and some others to report crypto transactions to their local revenue authority. So that's possibly all tying together as well. And then we have something much more old school, which is the low income trusts and estates reforms.
Yeah, so basically what's going to happen is that trusts and estates with income up to £500 won't pay tax on income as it arises. Where a settlor has made other trusts, the amount is the higher of £100 or 500 divided by the total number of existing trusts. They're going to remove the default basic rate and dividend ordinary rate of tax that applies to the first 1,000 slice of discretionary trust income. They're going to provide that beneficiaries of UK estates that not pay tax on income distributed to them that is within the 500 limit for the personal representatives. And they're going to make technical amendments to ensure for beneficiaries of estates that their tax credits and savings allowance continue to operate correctly. Now, the first three of those are going to happen between 2024 to 2025, and the last of those is going to happen 2023 to 2024. And
okay, so really, again, this is a simplification measure as much as anything else, which I mean will be welcome, because if you've got a low income trust or estate, the last thing you want to be doing is spending money on.
Oh yeah, it's a huge amount of faff if you've only got 500 quid or less there, isn't it? So I mean, it makes perfect sense and fits with their general plan, which seems to be simplifying a lot of the more minor aspects of the tax system.
Yeah, and nice to see something sensible, because I'm now going to ask Shane to tell us about something that isn't terribly sensible. Well, or you might think isn't.
Yeah, so they announced the tax exemption for group litigation order scheme payments related to the Post Office Horizon scandal. The government will provide exemptions from income tax, national insurance, and capital gains tax in relation to the group litigation order compensation payments that were made for some people who were, well, I suppose there's no other way really to describe them than they were victims of this whole debacle, which I'm sure some of the people on this call can go into a bit more detail on. There is also the compensation payment scheme tax exemption and relief regulations that were that actually specify exactly what those tax exemptions relate to, and specifically the dates from when they would apply or otherwise. But yeah, it's a scheme to try and compensate those people, or at least make sure they're not in a more disadvantageous position given the tax treatment of any awards that they were provided. Sorry, Harriet, I can see you're itching to get in there.
Yeah, I'm sorry, it's hard to shut me up, isn't it? So yeah, this was sort of, I think it was described as the scandal within a scandal, because you've obviously got this scandal where people have been wrongly accused of crimes and sacked and lost their livelihood and all the rest of it because the software didn't work, as I understand it, or the system, whatever, didn't work. And then because of the way the awards, the compensation awards are being made, you've got all sorts of issues like being pushed into a higher tax bracket, which I think is called the compression effect. And so, yeah, they've been left in a much worse financial position because of the way the awards are being made. So, as you say, this goes some way towards dealing with that.
Yeah. It's amazing it wasn't addressed. No one saw it coming, really. But
yeah, I mean,
it's better than nothing, isn't it?
Well, for the people who it attaches to, yeah. So that's a bit of a sad one, but at least something is being done, and quite a lot going on in direct taxes. Lou, can you start us off on those?
Yeah, so on the subject of open consultations, if we're eager to submit a response, the government announced a consultation today on VAT energy saving efficiency. So this story goes back to 1998. Since 1998, there's been VAT relief on the installation of various energy saving materials and technologies. At first, it initially related to things such as insulation, hot water system controls. But between 1998 and 2006, it expanded rapidly: solar panels, wind turbines, water turbines, all sorts of technologies. And then for one reason or another, in 2006, everything stopped. So the relief has been static essentially since 2006. So the government announced their consultation. Question one was, what else should be added to the list? And so if people have ideas on that, they can submit a response by the end of May. One of the things which the government specifically wanted responses on was electrical battery storage. The other question, which is exciting because it's a Brexit question, is before 2013, this relief, in addition to applying to the installation of technologies and materials in accommodation and domestic premises, applied to charities. For EU law reasons, they had to change the legislation so it no longer applied to charities. But now we have our freedom back and we have blue passports. The government has asked us, well, is that right? And so that's the second question of the consultation. Should this relief be extended to buildings used for charitable purposes?
Okay, well, that sounds like one to watch and potentially quite interesting. Anything else going on in VAT?
The other one is the VAT. No, well, there was an extension of both exemptions and zero rated supplies. So there's an extension on the zero rate of VAT on prescriptions for medicines when those medicines are supplied through patient group directions. So this is where people get prescriptions without having to actually have a prescription written there and then for them by a doctor or by a nurse. And then there's also an exemption on healthcare provided by staff who are being supervised by pharmacists. But these are, I mean, greater scheme of things, these are very small changes to the VAT regime.
Excellent. And I think we've got a few other sort of measures that could be called green measures or environmental measures. And I don't know, I think Rebecca and Shane are both going to talk about one of those. Is that right?
Yep, think so. So I'm not going to lie, most of the background to this one I know through Clarkson's farm. So taxation of environmental land management consultation. It's basically, since we've left the EU, a lot has changed in terms of the environment in which subsidies and things have to operate. And so this consultation is looking at, so the key thing of growing food, but also looking at the way in which we can protect the environment whilst doing so. And it's asking for responses on things like woodland carbon units, biodiversity units, and yeah, it's important. That's really all I can say.
So yes, we're not quite sure where that's going to lead yet. That seems to be quite an early stages consultation. Yeah. Okay. And Shane.
Yeah, so the landfill tax review, so the government published their response to a call for evidence on aspects of that tax. So the consultation ended in February 22. So a year later, they published their response on it. So I suppose some highlights from it. Government believes that there is some scope for material which is currently eligible for the lower rate of landfill tax to move up the waste hierarchy as such. And the current rate of tax charged on a lot of these materials does not provide sufficient incentive in many cases. So potentially increases coming down the line there.
I did not know there was a hierarchy of rubbish.
Well, it's amazing what you can find out when reading through these things during an afternoon. The government will review whether current exemptions and discounts within tax continue to support their environmental objectives, alongside any other options to improve the administration of that tax. And then they just made some other observations that waste crime harms the environment. So it's a balancing act between finding the sweet spot of the tax versus changing people's behavior, etc., in that area. So there's quite a lot of exciting changes going on in the world of landfill.
Yes, I can.
Some winners and some losers in that hierarchy, evidently. It's like the Premier League table.
That's it.
And I think there's a business rates review going on as well. Is that right, Selou?
Well, no, the review finished. Well, the review started in 2020 and then finished in October 2021. What happened today is after the government finished the review and gave their proposals, they invited stakeholder feedback, and they've published the stakeholder responses today. And so the essential proposal in the review concerns, firstly, the method, but more importantly, the frequency with which the rateable value of properties is reevaluated. They put their proposals to the industry gave their responses, those were published today. In terms of, I mean, the idea is that the stakeholder responses will feed into the bill which is going to be put into Parliament. The government has announced a few changes. So there was going to be a 3-month window the challenging re-evaluations from 2026, the government said, okay, that's going to be a 6-month window. There was going to be an obligation on ratepayers to inform the valuation agency within 30 days of a change in the occupier status or property characteristics. Again, that's going to be extended to 60 days. But essentially, it's more interesting because of what the government hasn't done or hasn't responded to. So in the autumn statement, the government said they were going to introduce a new 12-month relief called an improvement relief. That's designed to incentivize businesses to improve their properties. Unsurprisingly, businesses like this, and they said this is a really good relief, but it should be longer than 12 months. And the government essentially came back and said a flat no, 12 months is enough. The other thing
of consultation.
Yes, exactly. This is why people don't give responses to the consultations, because the government doesn't react.
As if they're going to get any agreement on business rates.
The other one is, so under the new system, rateable value of property is going to be re-evaluated every 3 years. So there was a question from businesses saying, well, is that frequent enough? What happens if there's macroeconomic changes or market changes or anything else within the 3-year cycle? Not only did the government not really respond to that, they actually came back and doubled down, and they said, well, firstly, 3 years is frequent enough, but secondly, they're actually going to legislate so as to make it abundantly clear that there are several things which can happen in the 3-year cycle which won't be sufficient to ground a material change of circumstances appeal. So again, it's a flat no from the government. They say that they say that what they published in October 2021 was good enough.
Excellent. And so I think that takes us mostly through our rundown of what was in the budget. I just want to mention a couple of things that the budget hasn't addressed. And the first one we've touched on, Shane, which is the horizon tax exemption does leave some people out because it doesn't cover anybody claiming under the historical shortfall scheme or the suspension remuneration review. So there's a number of ways that you can claim compensation, and only the GLO one is in fact covered at the moment. So there are still hundreds of people who have these tax issues and who aren't getting any relief or exemption. However, in good news, the government did just yesterday say they were going to introduce measures to fix the compression effect, i.e. this thing where you're getting pushed into a higher tax rate because you're getting effectively all of your income for a number of years in 1 year. So no details on how they're going to do that yet, but that's apparently going to happen. And the other thing that the budget hasn't addressed is something that people were talking about quite a lot this morning. This is the marginal rate of tax where you lose child benefit, and apparently that can be up to 91% effectively. Sorry, marginally, the marginal rate of tax on that income can be up to 91%, and the budget doesn't appear to have touched that either. So there's a couple of things that maybe surprisingly have been left out. I don't know if anybody's got any others. No.
Well, just quickly, I mean, the only thing that some people were talking about was whether or not it was going to be a change to the non-dom status regime, and that doesn't seem to have materialized at all.
I think that's one for when Labour get into power.
this is the thing, because the theory was the Tories might try and take the wind out of Labour's sails by getting in there first, but evidently they've decided not to, quite sensibly in my view, but there we go.
Well, it's complicated enough as it is, isn't it?
I think so.
But so we haven't really had anything on non-doms, and we haven't really had anything on inheritance tax. There's normally something to fiddle with on inheritance tax. We don't seem to have had anything at all. No.
Very, very niche one in relation to inheritance tax. What will qualify as a charity? And so I don't know the detail, but what I do know is that it's expected to get more European non-doms giving money more Europeans who are exposed to UK inheritance tax giving money to UK charities. But I'll have to come back to you with detail on that.
Oh, well, that sounds like there's a whole Tax Snacks episode right there. So thank you for joining us for Tax Snacks After Dark on the budget, and we hope that's been helpful. Thank you for all of your input.